Hello everyone, this is Ashmeet and welcome to my channel Litpinol. In our last video, we discussed about some single candlestick patterns where a trader needed just one candle to find a trading opportunity. However, in today's video, we will discuss about the patterns where a trading opportunity arises after analyzing two or three candles, which together form a pattern. These are the few important patterns that we will be discussing today. Have a glance at the name of these patterns and we'll move on to discuss each of them separately. The first pattern we'll discuss is the engulfing pattern. The word engulf means to cover. Hence, as the name suggests, in this pattern the first candle appears to be engulfed or covered up by the second candle. It is a two candle pattern, which means it is recognized by analyzing two candles together. This trend reversal pattern is of two types, the bullish engulfing and the bearish engulfing. Let us start by discussing the bullish engulfing. It is a bullish pattern which appears in a downtrend. In this pattern, the candle on day 1 should be red in order to confirm the downtrend or bearishness in the market, while the second candle on day 2 should be green and long enough to engulf the candle on day 1. The logic behind the bullish engulfing is that the prices were moving down in a downtrend and making new lows. This is confirmed by the red candle on day 1. The stock opens lower than the first candle's closing on day 2. However, at the low point, the bulls make an entry and takes the price higher than the day 1's opening, hence forming a green candle. This price action on second day shocked the bears and established bulls in the market. Hence, a buying opportunity appears for the traders. The trade setup for the bullish engulfing would be to buy around the close price of second candle, that is 2371 in the pattern encircled here in this chart. Whereas the stop loss would be the lowest of low amongst both the candles, which is 2310 of the first candle encircled in the chart. As we are done with the bullish engulfing, let's move on to discuss the bearish engulfing. Bearish engulfing appears in an uptrend and, as the name suggests, is bearish in nature. This pattern can be recognized by the green candle on day 1, confirming the bullishness in the market, while the candle on day 2 is red and long enough to engulf the candle on day 1. The logic behind this pattern is that the bulls were in absolute control of the market and taking the prices higher, which is confirmed by the candle on day 1. On day 2 the markets open even higher, but at the high point of the day the bears mark their entry in the market and take their prices lower, such that it closes below the opening of day 1. This price action in markets creates a shorting opportunity for a trader for the next few trading sessions. The trade setup for the bearish engulfing would be to short the stock around the closing of day 2, that is 306 in the pattern encircled here, whereas the stop loss would be the higher of the high of the two candles in the pattern. This sums up the engulfing pattern and we will discuss the Harami pattern now. Well, before you start thinking, this is not the word we use in Hindi. However, it is an old Japanese word which means pregnant. This will make more sense when you observe the pattern. But for now, the Harami pattern is a two candlestick pattern wherein the first candle is longer than the second candle and generally both have a different color. It is a trend reversal pattern and is of two types as engulfing. Let's start by discussing the bullish Harami. It is a bullish pattern which appears in a downtrend, and the logic behind this pattern is that the bears were in control of the market and were pushing the prices lower. This is confirmed by the long red candle on day 1 of the pattern. However, on day 2, the market opens even higher than first day's closing, which put the bears in a state of panic. With this panic, the market manages to gain strength and close somewhat below the previous day's opening. This formation of green candle on day 2 not only establishes the bulls but also unnerves the bears. Hence, the bullish Harami pattern suggests a trader to go long on a stock. The trade setup for the bullish Harami is to buy the stock around the closing price on day 2 and put the lowest low of the two candles as the stop loss. In this chart here, you can see that how the encircled bullish Harami pattern was profitable for the traders. Well, with this we are done with the bullish Harami and let's move on to discuss the bearish Harami. The bearish Harami is a bearish pattern which appears in an uptrend and provides the traders with an opportunity to short the stock. The thought process behind the bearish Harami is that the market was making new highs in an uptrend as the bulls were in absolute control of it. On day 1, the market again made a new high and formed a green candle, which confirmed the bullishness in the market. However, on day 2, the market unexpectedly opened lower than day 1's closing and displaced the dominance of the bulls. With this panic set in, the market continued to trade lower, which resulted in the market closing in red on day 2. The closing price on day 2 is somewhat higher than day 1's opening, such that if we visualize the two candles together, it might give you the real sense of the Japanese word harami. Well, that is about the logic of the pattern. Let's move to discuss the trade setup now. This pattern creates a selling opportunity for the trader, hence a trader should look to sell the stock around the closing on day 2, with the stop loss being the highest high of the pattern. Now we have almost reached the last section of this video, where we will discuss the two patterns which are favorite of many traders. But in order to discuss them, let's learn about a very easy pattern which sets the base for the other two. Well, this pattern is gaps, and as its name, it literally means the same. The gaps appear on daily chart when the stock closes at one price but opens on next day at a very different price. Well, it is of two types as you can see in the slide, a gap up and a gap down. A gap up indicates the bullish sentiments, which means that the open price on second candle is way higher than first candle's opening and closing price. This gets more clear when you comprehend it keeping in mind the picture on your screen. The gap down indicates the bearish sentiments, which means that the open price on second day is way too low than the opening and closing price of day 1. Now it's time for the most important part of the video. We'll move to discuss the morning star and the evening star pattern. Let us start by discussing the morning star pattern. The morning star is a bullish pattern which evolves over a period of 3 trading sessions or candlesticks and appears at the bottom end of a downward rally. The thought process behind this logic is that the bears were in control of the market, which is confirmed by the red candle on day 1. On day 2, the dominance of bears is indicated through a gap down opening, whereas the candle formed is a doji or a spinning top. As we have discussed in our previous video that doji and spinning top marks the indecision in the market, this indecision puts the bears in a state of panic as they expected the market to make a new low. However, on day 3, the market opens with a gap up and forms a long green candle where it manages to close above the day 1's opening price. This action on day 3 is what displaces the bears and establishes the bulls in the market. As gap up is in itself a bullish pattern, the long green candle adds up to change the momentum of the market, and traders are presented with an opportunity to go long on the stock. The trade setup for the morning star is to buy the stock around the closing price of day 3, where the lowest low of the 3 candles will act as the stop loss. In this chart here, you can see that how the traders would have benefited by going long on the stock. And this is all we had for the morning star, and we'll move on to discuss the evening star now. The evening star is similar to the morning star but is just the opposite of it. It is a bearish pattern which appears at the top end of an upward rally. The appearance of this pattern can be verified by confirming these 3 candles together. The first factor is the appearance of the green candle on day 1, which confirms the bullishness in the market. On day 2, the bullishness in the market continues with the gap up opening, but so does the uncertainty, as the candle is a doji or a spinning top. This uncertainty causes panic for the bulls, and on day 3, the bulls completely loses their stronghold. With the gap down opening, a long red candle is formed with its closing below the opening price of first day's candle. This action on day 3 brings in a shorting opportunity for the traders, and as you can see here in the chart, that how the traders would have benefited by analyzing this pattern. The trade setup for the evening star would be to short the stock around the closing price on day 3, with the highest high of the pattern as the stop loss. That's all we had for today's video, and if you liked it and want to open your Demat account to test your knowledge, the link is in the description below.